company is considering a project that produces cash inflows of 420,000. So cash inflows is 420,000 for year 1 through year 5. So for all the 5 years, we have got the same cash inflow of 420,000 and a net cash inflow of 100,000 in year 6. Okay, so year 6, there is a different figure and that's 100,000. The project requires an initial investment. Initial investment means cash outflow in year 0 of $1.8 million. Salem's cost of capital is 10%. Find the NPV of the project to the nearest $100. So the options are A, $83,000, B, negative $108,200, C, negative $151,400, and D, negative 442,000. What is the right answer? I will just help you with the format and then I want you to do this on your own. So let's first write the table. So we have the year, the cash flows, the discount factor, and the PV as the column headings. So here, how many years are there? We have got till year 6. So the years are 0 to 6 and cash flow. For all the 5 years, we have cash inflow of 420,000. That's why 420,000 has been written from year 1 to 5. And in year 6, we have an inflow of 100,000. So that's why 100,000 is shown against year 6. And in year 0, what's the initial investment? Initial investment is 1.8 million. It will be shown as a negative figure. So 1.8 million. Next column is discount factor at the rate of 10%. So you refer the PV table. So here, the first one, in year 0, you have just 1 because that is not to be discounted because that is already in present value terms because year 0 is now. For all the coming years, that's 1 to 6, we need a discount factor. So looking up the PV table, we have from 1 to 6 indicated on the right side of the slide. So we are just copying those figures and we will be jotting down the discount factors against years 1 to 6. So we have the information to do the problem. So what is the present value? What you have to do is you have to multiply cash flow into the discount factor column. You will get the present value. And then you add, you will get the net present value. Please note that the first figure will be a negative figure because that's a cash outflow. So I want you to do this on your own and tell me what is the right answer. Pause the video, do it, and get the answer right. So what we have to do is we have to multiply the cash flow column with the discount factor column. So in year 0, we multiply 1.8 million into 1. We have the present value as again negative 1.8 million. In year 1, we have 420,000 into 0.909. Likewise, we multiply each cash flow with its respective discount factors and we get the present value as follows. We add the total of the present value column to get the NPV and the answer is 151,426 negative as the NPV. So they have asked you NPV to the nearest $100. So what's the answer? The answer is 151,400 and that's the right answer. So I hope all of you have got the right answer. Now in this problem, there is an easier method to do it. We always want to do the easy method, right? So look at this. Here we have 420,000 identical numbers. That is, the cash flows are identical. So what have we done? We have actually multiplied 420,000 into 0.909, we get the answer. Again, 420,000 into 0.826, we get the answer. 420,000 into 0.751, we get the answer of the present value. Why should you do that? All that you have to do is 420,000 is common. So we just add the present value factors. What is the total of this present value? Total is 3.791. Instead of individually multiplying 420,000 with the respective present value factor of each year, you just total the present value factor. And then in one shot, multiply with 420,000. So what do you get? 420,000 That is, in one shot, you're multiplying with the total of the present value factor, that's 3.791, and you get the answer as 159,220. So in one shot, you get the total of all these figures. We get the total of all these figures in one shot. So that is pretty easy. So whenever you have identical cash flows, what I want you to do is, I want you to add the present value factors of those years. So in this particular case, 420,000 is repeating from year 1 to 5. So add the present value factors from year 1 to 5, get the answer. So in this particular case, it's 3.791. Add it and then multiply it with 420,000. In one shot, you will get the answer. Okay. And this 3.791, instead of adding it, we have another easier method, and that is the annuity table. So we will just take a look at the annuity table and see whether we get this figure 3.791 against year 5 when the cost of capital is 10%. This is the annuity table, and if you see against 10% and against n is equal to 5, you have the very same figure, that is 3.791. So this 3.791 can either be looked into the present value table, just add it, or you can also look into the annuity table where you get the 3.791 in one shot. Question number 2, a company is considering buying a machine that cost 100,000. So the cost of the machine is 100,000, or that will be your cash outflow in year 0. And it has a 20,000 scrap value. What do you mean by scrap value? Scrap value is the amount that you get when you sell the asset after its useful life. The machine will produce annual operating cash flows of $25,000 each year. See this? 25,000 each year. It's an identical cash inflow that's going to happen, which means that you can refer to the annuity table, or you could add the discount factors from the PV table. And it has a 6-year life. Use discount rate at the rate of 10%. What is NPV? So the options are option A, negative 2,405, option B, 8,875, option C, 20,155, and option D, 28,875. So those of you who know how to tackle this problem, I want you to write the table and tell me the answer. Pause the video and try it on your own. Okay, so you have the table here, year, cash flows, discount factor at the rate of 10%, and last column is the present value. So how many years do we have? We have a total of 6 years. So in the first column, in the year, you have from 0 to 6, and cash flow. What is the cash outflow in the first year? It is 100,000 because that's the cost of the machine, indicated as a negative figure. Then you have a 20,000 scrap value that's at the end of the useful life, or at the end of 6 years. So you have $20,000 coming in as a cash inflow in year 6. You have cash flows of 25,000 each year. For all the other years, that is from 1 to 6, you have a cash inflow of 25,000. So I'm going to write here 25,000 from year 1 to 5. In year 6, we have 20,000 already. So add 20,000 plus 25. So you get 20,000 plus 25,000, that's 45,000. What is 20,000? 20,000 is the scrap value. And what is 25,000? 25,000 is the cash inflow that is happening from year 1 to 6. So in year 6, you've got 2 cash inflows. One is the scrap value and the other one is the cash inflow from the machine. So total is 45,000. I will be writing that against year 6. Discount factor at the rate of 10%. So in year 0, it's always 1 because that's already in present value terms, because that is now. And you have the present value factor. So at the rate of 10%, if you notice here from year 1 to 5, you have the same figure. So what should you do? Add it. Add the present value factors from year 1 to 5. Please add the present value factors. You get the total as 3.791. Write the same figure against the discount factor. And what should you do? And as for the last year, it's a different amount because it's 45,000. So we just copy the present value factor of year 6. So it is 0.564. So we have the discount factor. Now what should you do? We should find out the present value. So year one, it's negative 100,000 into 1. So we have negative 100,000 in the last column. And from year 1 to 5, what should you do? We should multiply 25,000. That's a single 25,000 into 3.791 because that's the total. So you get the total as 94,775. That's the present value from year 1 to 5 as a total figure. And in year 6, you have 45,000 into 0.564, you get 25,380. So whenever you have identical flows, identical cash inflows, what I want you to do is you have to add the present value factor from year 1 to 5 and write it as a single figure and multiply it with 25,000. So what is the NPV? NPV is 20,155. So the right answer is option C. I hope all of you have got the answer, and I hope that you have added the discount factors and written it as a single figure. Alternatively, you could also refer to the PV table. 10% and against year 5, we have the total of the present value factors from year 1 to 5 already calculated for us. That is 3.791. So you could also copy that figure and get the very same answer. This is what I want you to know. 3.791 can either be total from the PV table, or you could look up the annuity table where it is already calculated for us. Okay. Okay, the next topic is sensitivity analysis. What do you mean by sensitivity analysis? Now, before we go into that, I will give you a simple example. You have an NPV of $1,000. Okay, you have calculated an NPV of $1,000 for a project. So what do? If it's a positive NPV, we will naturally accept the project. So we have accepted the project. But the next year, the sales that we projected did not happen. There was just a 1% decrease in sales, and the NPV turned out to be negative, and our project was a failure. So what is the meaning of this? We have to analyze what is the dip in sales that will cause the NPV to be negative. So this is very important because we are trying to find out how much risk are we taking. Even a 1% decline in sales, if it results in a negative NPV, then we should think twice before we accept the project. So this is what we are going to find out in sensitivity analysis. So we will just see what the definition looks like. It is used to find the maximum percentage change acceptable in cost or in revenue before decision is changed. Cost or revenue. But in this particular case, we will study only the sales part or the revenue part. That is, how much the sales can fall. How much the sales can fall without getting a negative NPV, or what is the maximum drop in sales that we can suffer without getting a negative NPV. Question number 3, details of a project in dollar. Present value of sales, $50,000. Present value of variable cost, $20,000. Present value of contribution, $30,000. We already know that sales minus variable cost gives the contribution. So what they have done, 50 minus 20,000, they have got a figure of $30,000 as a contribution. Then the present value of fixed cost comes to 15,000. You reduce that from contribution, you get the present value of operating income. So it's 30,000 minus 15,000. You get 15,000 is a present value of operating income. Then you minus the initial investment of 5,000. And you get the NPV as $10,000. So NPV is 15,000 minus 5,000. You got the NPV as $10,000. So already they have calculated the NPV and kept. And what is asked? What is the sensitivity of NPV to changes in sales volume? What is the maximum drop in sales that the project can suffer without getting a negative NPV? So the options are A, 33%, B, 30%, C, 25%, and D, 40%. So we have to find out what is the drop in sales that is acceptable to us without getting a negative NPV. Sales and contribution are related terms. When sales fall by 10%, contribution also falls by 10%. If you recollect what you studied in marginal costing, you know that When sales drop by a certain percentage, contribution also drops by a certain percentage. So instead of telling what is the maximum percentage change in sales, we can also say what is the maximum percentage change in contribution that is acceptable, because that's the same thing. The drop in sales percentage is the same as the drop in contribution percentage. So now what we will do is we will assume NPV as 0. Okay? NPV as 0, because we don't want the NPV to be negative. So we assume NPV as 0 and then we work backwards. Okay? So we have an initial investment of negative 5,000. So I'm writing the very same figure, negative 5,000, and backwards working. So if NPV is 0 and initial investment is 5,000, then what is operating income? Operating income will be 5,000, because only then you will get 5,000 minus 5,000 is equal to 0. We are just working backwards. And present value of fixed cost, that is again negative 15,000. So I've written the very same figure and you backward and you work backwards. So it is 5,000 plus 15,000, you get 20,000 as a contribution. What does this mean? When contribution is 20,000, our NPV is reduced to 0. Now we cannot reduce the contribution even by $1, because that's the maximum permissible reduction that is acceptable. If you reduce the contribution again, then NPV will turn out to be negative. So 10,000. So contribution can change by $10,000. How did I get that? It's 30,000 minus 20,000. So $10,000 is the maximum reduction in contribution that is acceptable. From 30,000, the contribution can drop to 20,000, which means that the difference is 30 minus 20,000, or the contribution can reduce by $10,000. As a percentage, how do you express it? $10,000 divided by 30,000 divided by the original figure of contribution. So 10,000 divided by 30,000, that is the maximum percentage change. So you have 10,000 divided by 30,000, or 33%. 33% the contribution can drop. That is okay, because even if the contribution drops by 33%, you will still get an NPV of only 0. You will not get a negative figure. So that's okay for us. So the maximum permissible change that is acceptable is 33%. Now this method is very tedious. We don't want to do all this long method to find out the sensitivity of NPV. Let's see whether there is any shortcut. So the shortcut formula is sensitivity of NPV to change in sales volume is given by the formula NPV divided by the present value of contribution. So what is NPV? NPV is $10,000 and present value of contribution is $30,000. So what is the answer? It's 10,000 divided by 30,000, 33%. In one shot, we get the answer. No backward working, no hassles, just substitute in the formula. You will get the answer of the sensitivity of NPV to changes in sales volume. So the right answer is 33%, option A. We will have a quick recap. Point number 1, what is the sensitivity of NPV to changes in sales volume? Given by the formula NPV divided by present value of contribution. No backward working, no hassles, just substitute in the formula, you will get the answer. What is the meaning of this? What is the maximum permissible reduction in sales that is acceptable without getting a negative NPV? Point number 2, we have the table for calculating the net present value. So in the first column, you have the year. So you jot down the number of years which is given in the question, starting with year 0, that is now. And the first row will have the investment. It will be a negative figure because that's a cash outflow. And all the other years, you will have a positive cash flow. And the discount factor for year 0 will always be equal to 1. You don't need to discount it because it's already in present value term, because that is now. Okay. And if you have the same figure, now this is 20,000, 20,000 for year 1 to 4. So these are identical items. So what should you do? When cash flows are identical, you have to add the discount factors from the PV table. So from year 1 to 4, you add the discount factors, or you can refer to the annuity table, and then you calculate the net present value by adding the last column. So that will be your net present value. That's it for today. If you have understood the class, I request you to press the like button so that I will come to know that my class is fine and okay. And if you have not understood, I want you to post your doubts in the comment box below so that I will be able to clear it later. Thank you.